Every single day, trillions of dollars flow blindly through the arteries of the global financial system. When you deposit your paycheck into a bank account, when a pension fund invests the life savings of 1 million teachers into the stock market, or when a massive multinational corporation acquires a smaller competitor, the entire transaction relies on one fundamental, invisible pillar of modern civilization: trust. You trust that the bank actually holds the capital it claims to hold. You trust that the publicly traded company is actually generating the revenue it reports on its quarterly earnings calls. You trust that the financial statements of the global economy are not just a sprawling, fabricated work of corporate fiction. But why do you trust it? How do you actually know that the numbers on a screen represent physical reality? You trust it because of a stamp of approval, a signature at the bottom of an annual report. You trust it because the numbers have been audited. We are taught to view auditors as the ultimate financial referees. They are supposed to be the objective, incorruptible guardians of capitalism, marching into corporate headquarters, opening the ledgers, and verifying that the executives are not lying to the public. But what if the referee is on the payroll of the team they are supposed to be officiating? What if the guardians of the global economy have quietly morphed into a private, untouchable cartel? Welcome to the terrifying reality of the Big Four. If you look at the largest, most powerful corporations on the face of the earth, the entire S&P 500, the Fortune 500, the massive banks, the tech monopolies, the defense contractors, virtually 100% of them are audited by just 4 companies: Deloitte, PricewaterhouseCoopers, Ernst & Young, and KPMG. These 4 firms form an absolute, impenetrable oligopoly. They act as the private regulators of world capitalism. They hold the keys to the global financial system, generating over $200 billion in combined revenue every single year. And they are operating with a fundamental, catastrophic conflict of interest that has already caused some of the most devastating economic collapses in modern human history. To understand why the global financial system is sitting on a ticking time bomb, you first have to understand the foundational flaw of the modern audit. It is a flaw so obvious, so painfully simple, that it feels like a mistake. Who pays the auditor? In a rational system, an independent regulator would assign an auditor to a corporation, and the regulator would pay them to ensure total objectivity. But that is not how modern finance works. In our system, the corporation hires its own auditor. The CEO and the board of directors literally sign the paycheck of the exact people who are supposed to be rigorously investigating them for fraud. If an auditor does their job perfectly, if they dig deep, find accounting irregularities, demand restatements, and make life miserable for the corporate executives, what happens? The executives simply fire them. They terminate the contract and hire one of the other 3 firms who might be more cooperative. There is an immense, unspoken financial pressure on the auditor to look the other way, to accept the client's creative accounting, and to keep the relationship smooth. Because an audit contract for a massive multinational corporation isn't just a one-time job. It is a recurring multi-million-dollar annuity that pays out every single year. But the multi-million-dollar audit fee is actually just the bait. The true danger of the Big Four lies in their real business model. The Big Four do not want to be just auditors. Auditing is a low-margin, high-liability, boring profession. The real money, the staggering, astronomical profits that fuel the partners' yachts and skyscrapers, is in consulting. These firms operate as massive advisory empires. They want to sell corporations strategic advice, IT implementation, supply chain optimization, and, most importantly, tax avoidance strategies. This creates a terrifying dynamic known as cross-selling. Imagine you are the lead auditor for Deloitte or PwC, assigned to verify the books of a massive pharmaceutical company. You are being paid $10 million for the audit. But your bosses at the firm are leaning on you to leverage your relationship with the CEO to sell them a $50 million software consulting package. Are you going to jeopardize a $50 million consulting deal by blowing the whistle on a questionable accounting practice? Are you going to risk infuriating the chief financial officer when your firm is desperately trying to secure a massive tax advisory contract with them next quarter? The answer, historically, is no. The auditor becomes captured. The watchdog becomes a lapdog. This is not a theoretical vulnerability. This exact conflict of interest is the blueprint for the most spectacular corporate frauds of the last century. Let's go back to the year 2001. Back then, it wasn't the Big Four. It was the Big Five. The crown jewel of the accounting world was a firm called Arthur Andersen. Arthur Andersen was the auditor for an energy company called Enron. Enron was the darling of Wall Street, reporting billions of dollars in profits, praised by analysts as the most innovative company in America. But Enron's profits were a total illusion. They were using incredibly complex, fraudulent accounting vehicles to hide massive debts and fabricate revenue. It was a corporate house of cards. And Arthur Andersen, the independent auditor, didn't just miss the fraud. They actively helped design it. Why? Because Enron was paying Arthur Andersen $25 million a year for the audit, but they were paying them an additional $27 million a year for consulting services. Enron was one of their most lucrative clients. Arthur Andersen's partners were so terrified of losing the consulting fees that they signed off on blatantly fraudulent financial statements. When the house of cards finally collapsed, wiping out $74 billion of shareholder wealth and destroying the retirement accounts of thousands of employees, the truth came out. As the federal investigators closed in, Arthur Andersen executives frantically began shredding thousands of pounds of audit documents. The scandal was so profound that it literally destroyed Arthur Andersen. The Big Five became the Big Four. In the aftermath, politicians were outraged. Congress passed the Sarbanes-Oxley Act, a sweeping piece of legislation that was supposed to strictly limit auditors from providing consulting services to the companies they audit. It was supposed to fix the conflict of interest forever. But the Big Four are masters of the loophole. Over the last 2 decades, they have quietly rebuilt their consulting empires. They found legal workarounds. They lobby regulators relentlessly. Today, the consulting revenues of the Big Four absolutely dwarf their auditing revenues. The exact same toxic incentive structure that destroyed Enron is alive, well, and exponentially larger today. If you think Enron was ancient history, let's look at the modern era. Look at Wirecard. Wirecard was the pride of the European tech scene, a German payment processor valued at nearly $30 billion. They were audited for over a decade by Ernst & Young, one of the Big Four. For years, short sellers and financial journalists screamed that Wirecard's numbers made no sense. They alleged that the company was fabricating revenue in Asia. Ernst & Young dismissed the allegations. They stamped the audits year after year, providing Wirecard with the ultimate shield of institutional legitimacy. But in 2020, the illusion shattered. It was revealed that $2 billion in cash that Ernst & Young had signed off on as existing in bank accounts in the Philippines simply did not exist. It was a complete fabrication. How does one of the most sophisticated accounting firms on the planet fail to notice that $2 billion of a client's cash is entirely imaginary? They didn't even bother to request original bank statements from the Philippine banks. They relied on screenshots and forged documents provided by the very executives they were supposed to be auditing. In the United Kingdom, look at the collapse of Carillion, a massive construction conglomerate audited by KPMG. Carillion went bankrupt overnight, drowning in billions of pounds of hidden debt. Just months before the collapse, KPMG had signed off on their books, calling the company a going concern. The systemic failures are relentless. But unlike Arthur Andersen, the modern Big Four face almost zero existential consequences. When Ernst & Young misses $2 billion at Wirecard, when KPMG fails at Carillion, when PwC is caught up in massive tax leak scandals in Australia, they are fined. Sometimes the fines are hundreds of millions of dollars. But to a firm making $50 billion a year, a $200 million fine is not a punishment. It is just a business expense. It is the cost of maintaining the cartel. And this brings us to the most terrifying reality of the Big Four. They have achieved the ultimate form of regulatory capture. They are too few to fail. If a government regulator were to actually drop the hammer, if the SEC were to ban Deloitte or PwC from auditing public companies due to repeated, systemic failures. The global economy would physically halt. There are only 4 firms on Earth with a massive global infrastructure required to audit a company like Apple, ExxonMobil, or JP Morgan Chase. You cannot ban one of them, because the remaining 3 literally do not have the manpower to absorb the workload. If you destroy one of the big 4, public companies would lose their auditors, their stocks would be delisted from the exchanges, and trillions of dollars of market capitalization would evaporate overnight. The governments of the world know this. The big 4 know this. They are operating with complete, functional immunity. They have constructed an economic reality where they are structurally indispensable, and their power extends far beyond just checking numbers. The big 4 essentially write the rules of global capitalism. They operate a massive revolving door with the world's governments. Senior partners at the big 4 routinely leave to take high-level positions at the IRS, the SEC, and the European Central Bank. They draft the tax codes and the financial regulations. Then, a few years later, they leave the government, return to the big 4, and charge multinational corporations tens of millions of dollars to exploit the exact loopholes they just wrote into the law. They are the architects of the global offshore tax haven network. They are the masterminds behind the intricate corporate structures that allow trillion-dollar tech companies to pay an effective tax rate of almost 0. We live in a world where the financial police are paid by the suspects, where the judges are actively consulting for the defendants, and where the rulemakers are the primary beneficiaries of the loopholes. The big 4 have commodified trust. They have turned the concept of financial oversight into a multi-billion-dollar shield that protects the worst impulses of corporate greed. The next time you read an annual report or invest in a massive index fund, remember the fragile, compromised foundation it all rests upon. The global economy is a house of cards, and the 4 companies hired to inspect the foundation are the exact same people selling the wind.
Thanks for watching Macro Explainer. Subscribe for more clear breakdowns.